Hi again and welcome back. This module is going to be quite exciting as we will talk about the basic accounting equation. Be ready to flex those calculators? Before we dive into the numbers, allow me to share something beautiful that I read from the American Institute of Certified Public Accountants, or AICPA. It offers a very insightful way of viewing the definition of accounting, that is, emphasis on its use and emphasis on its activity. Take a look at these two definitions. Accounting is a discipline which provides information essential to the efficient conduct and evaluation of the activities of the organization. What does this tell us? This tells us that the main focus of accounting is the business. Accounting provides information about the business for its stakeholders. Ergo, whenever we analyze business transactions, we analyze it from the business's point of view. It is very important that we keep this in mind. And then there's this. In accounting, the effects of the economic activities are accumulated, analyzed, quantified, classified, recorded, summarized, and reported as information. Now, what does this tell us? Well, this tells us about the job of accountants. It gives us an idea about the multifaceted role that an accountant plays in order to give accounting the voice that is needed to become the language of business. As the definition implies, an accountant filters which data are relevant to the decision to be made. Afterwards, we process and analyze these data and convert it to information that will be used by the different stakeholders in making their decisions. Now that we have laid that out, let us get to know some common concepts that will be useful when we start using the basic accounting equation and analyzing transactions, such as the separate entity concept. This concept reminds us that the business and the owner are separate and distinct from each other. This simply means that the personal transactions of the owner should not be recorded in the business's books, and the business transactions should not be reflected as the owner's personal transactions. We also have the going concern assumption. This assumption takes on the question, "May forever nga ba?" Kidding aside, how long do we expect the business to last? A year? Maybe 5 or 50 years? Well, under the going concern assumption, the life of the business is expected to last forever unless evidence exists to the contrary. And because we assume that the business will live on forever, then this necessitates what we call the time period or periodicity concept. Just like how human beings celebrate birthdays, the life of the business is also divided into meaningful time periods, usually a period of 12 months or 1 year. There are basically 3 types of years in accounting. We have the calendar year, which always starts on January 1 and ends on December 31. We have what we call the fiscal year, which starts on any day except January 1 and ends 12 months after, and the natural business year, which is a 12-month period that ends when the business is at its lowest point, or what we call its slack season. And then there's the accrual basis of accounting. Alright, for this one, I would have to ask you a question. What if you agreed to tutor your classmate for 100 per hour? You have already completed 2 hours of tutorial sessions, but your classmate has not paid you yet. Will you already recognize this as income? Remember, you have not yet been paid. Now, under the accrual basis of accounting, the answer is yes, it is to be recognized as income. You see, under the accrual basis, revenue is recognized when earned, regardless of when you receive the cash. This gives rise to what we call receivables. In the same manner, if you have already utilized, say for example, the electricity, but have not yet paid for it, it will still be recognized as an expense because under the accrual basis, expenses are recognized when incurred, regardless of when you pay for it. This gives rise to what we call as payables. Okay. We have already mentioned 4 of the most important concepts you would need for Accounting 101A. And now, the moment you've all been waiting for. Calculators out, let's talk about the basic accounting equation. This is the most important equation in your accounting journey. Never, ever, ever forget this. Assets equal liabilities plus equity. In the left side of the equation, you will find assets. In very simple terms, assets are resources of the entity. These are what the business owns. On the right side of the equation, we will actually find what the business owes. In more technical terms, this represents the claims against the company's assets. A business may owe external sources, called creditors, represented here by liabilities, or it may owe internal sources, called the owners or equity. Remember that the total of the left side always equal the total of the right side. The equation always balances. Always. Let's have a simple illustration. Suppose you want to open an online accounting tutorial business. What would the business need? Well, for starters, let's say it will initially need money so that it can purchase other stuff, right? In accounting, we call this money as cash. Now, how will the business generate cash at its inception? Basically, two possibilities. It can either borrow money from a creditor or it can source the money from its owner. So, suppose in this example, the business needed a startup capital of 100,000 and the owner of the business invested cash of 70,000 while the remaining 30,000 was sourced from a credit institution. How will this be reflected in the basic accounting equation? Well, assets, in this case in the form of cash, will increase from 0 to 100,000 because the business now has cash. It will also recognize that the business owes its external creditors, in this case in the form of a loan payable amounting to 30,000. And the business also owes its owners for his investment, in this case, owner's capital, of 70,000. Total assets, 100,000. Total liabilities and equity, 100,000. The equation always balances. Amazing, right? Now, another way to appreciate the basic accounting equation is that it actually gives us a snapshot of the business's financial performance as of a specific period. Let's go back to the previous example. This equation simply tells us that should the business decide to close right now, 30% or 30,000 out of 100,000 of its assets will go to the payment of external creditors. Out of its total assets of 100,000, only 70% will be returned to the owners. This simply means that currently, the entity is leveraging or relying mainly on its owners or equity rather than its liabilities. Interpretations like this are especially useful to those in management accounting. Let's try to apply what we have just learned to these very simple illustrations. Ready? If total assets is 10,000 and total liabilities is 6,000, how much is total equity? The answer? 4,000. Now, if total liabilities is 5,000 and total equity is 4,000, how much is total assets? 9,000, of course. If total assets is 10,000 and total equity is 3,000, how much is total liabilities? And the answer? 7,000. Great! As you can see, the equation always balances. No exceptions. It always balances. Now that we have warmed up, let's take the extra mile and work on these illustrations. Now, the first illustration is a bit of a puzzle because here you see that total liabilities is 48,310 but the total equity is negative 17,180. Let's let that sink in. Equity is negative. How can that be? In accounting, negative equity is called a deficit. This happens when the business has been suffering so many losses that the owner's capital is not enough to absorb it. Now let's compute for total assets. Take note that equity is negative. Alright, total assets should be 31,130. If you doubt your answer, just check back on the equation. It always balances. So on the left side, you have 31,130. Now let's check the right side. 48,310 plus negative 17,180 is still 31,130. Good, we have maintained the balance in the equation. Now, let's move on to the next one. How much is total equity? Answer? 255,000. Splendid. How about this? How much is total assets? The answer? 500,000. Awesome. Now this. Compute for total liabilities this time. And the answer? 230,000. Fantastic. And finally this. Compute for total liabilities still. The answer? 52,750. Remarkable. Now, let us try to elevate our appreciation of the basic accounting equation by trying to examine each of these businesses' financial position. Let's take a look at the first two companies. Which do you think is doing better? Now, as you would notice, the first business registers a deficit. This means that should the business close, all of its assets are not even enough to cover the payment of all of its liabilities. Nothing goes back to the owner. In fact, the owner may even be obligated to put in additional investment just to pay off all the business's liabilities. This business is not doing well. Let us now compare the second and third businesses. I'll give you a few seconds to give me your insights on this. Okay, so if we compare, should the second company close, 43%, that is 195,000 divided by 450,000, will go to its creditors, while 57% will be returned to its owners. Compare that with the third business, with 30% of its assets to be used as payment for liabilities, while the remaining 70% will be returned to the owners. Now, which of the two do you think is the better company? Actually, it depends. At the onset, it would appear that the third business is doing better because it actually returns 70% to the owners if the business closes right now, right? But there's another school of thought that says, well, what if the business does not close yet? It might mean that the business was not able to maximize the benefits of getting debt and is relying too heavily on invested capital, thereby putting too much reliance on the owner and the business operations. One student of mine even said, "Miss, it could be that the business has not yet built its reputation. That's why it cannot get any loan or is not afforded any credit." Interesting, right? That is how beautiful accounting is. It does not only compute the figures for us, but it leads us to ask very interesting questions that will later on assist decision makers. Now, let's go the extra mile. This time, let us expand the basic accounting equation. And to do that, we have to look at equity. You see, equity is quite fascinating because if you dig deeper, you will realize that it is actually made up of four components. Well, first, of course, you have the beginning equity or the equity at the start of the year. This will then be increased by whatever additional investment the owner makes during the period, as well as income that the business has earned. Remember the accrual basis? What is important is when it is earned, not when cash is received. This will be reduced when the business incurs expenses and will further be decreased when the owner makes a withdrawal from the business. These components make up the expanded accounting equation. Now, another interesting thing to note is that the difference between income and expenses actually paint a picture of the financial performance of the business as captured by what we call profit or loss. If income is greater than expenses, then the owner is happy because the business made a profit. However, when the expenses are greater than the income, then the business suffered a loss. In the very rare event that income is exactly equal to expenses, then we have what we call a break-even. Let's have a simple illustration. Using these three scenarios, compute for profit or loss. Alright, the first case is a profit of 7,000. Very good. Income is greater than expenses, so it's a profit. The second case is a loss of 6,000. In this case, income is lesser than expenses, so it's a loss. And finally, we have a break-even, where income is exactly equal to the expenses. Fantastic. And now let's have one illustration to show the expanded accounting equation. If total income is 10,000, total expenses are 8,000, total liabilities is 7,000, and total equity before any profit or loss is 6,000, and the owner made a withdrawal of 1,000 during the period, how much is the total assets? Plotting that in our expanded accounting equation, our total assets should be 14,000. Splendid. Remember, the equation always balances. Now, determine the financial performance of this business by computing for the profit or loss. Alright, this business has a profit of 2,000. Impressive job, you guys. Now, before we say adieu to this module, allow me to briefly present to you the accounting cycle. Pay close attention because this is what you will be living out in your entire Accounting 101 age journey. So as you can see, there are 10 steps. Some of these steps are optional, but let's cross the bridge when we get there. I am pointing this out because in our next module, we shall be doing the first step, identifying and analyzing transactions. That's going to be an exciting one, so make sure to check out our next module. Until then,